All right, guys, I just want to upload another video talking about a price distinction that incorporates liquidity concepts and something you might be able to utilize. Anytime you see this price distinction where price moves up pretty impulsively and then moves up above a prior high and then sells back into the range, that's generally a sign that whatever momentum was leading into that is essentially gone, and typically it's telling you that the bulls and the bears have fought it out. In this case, the bulls have lost. Liquidity's been ran to the upside of the range, and price is probably going to go lower, and that's exactly what you see right there. Let's try to see if we can find more of these. Again, this is a liquidity concept, so anything has to be kept in mind with that concept. Here you see another good example, right? So you get this impulsive movement up, and then you get this consolidation range, and then price runs up above the range and slams back down into the range. Anytime I see that, that's telling me that, look, liquidity's been ran to the upside of the range. It's probably going to look for liquidity lower, and that's exactly what you see. It gives brief reactions, at tradable levels here, but it's really only scalps, right? So scalp there, breaks through, hits this level here, gets a reaction, breaks through. This one isn't really a great example. Here's a good example here, actually. Not really that much of an impulsive move, but you do see this move here, and then price runs below these lows, and then quickly closes back within the range, and then price moves up higher. I guess this one works as well. So you have this impulsive move up, price runs up above the range, slams back down. And reacts at this tradable level, but within the greater context of kind of what we were talking about. If I see this pattern, then I'm thinking, okay, it's probably going to break lower. And it did. Price kind of drifted upwards, but if you see this type of price, this is not bidding in the market. This is just price just drifting upward, and then the sell orders hit, slam down, run below for liquidity. So if you traded this level and you had a stop up here, you would have been able to take profit out of the market. Let's find more of these. Let's see. So not really a great example here. You may have. So here's a good example of where it didn't work out, right? I mean, so maybe you were looking at this as an impulsive move, clearly an impulsive move, and then you see this distinction, right? Price runs up and then slams down. So maybe you're looking for it to retrace and fill liquidity in. Well, whenever you see this pattern, right, if price just slowly grinds at resistance and builds up there, once I start seeing this type of behavior playing out, then that's strength. I look at that as strength, and it's different than some of the other distinctions we were looking at. Again, here's an example of where it worked out and yet didn't work out at the same time. So you see that distinction here. Price runs up after an impulsive move, runs up above the highs, slams back down. So here, this is probably a 618 retracement or so. Let's see. Yeah. So it runs up to the retracement, and then you get a breach of liquidity. So again, it's not necessarily going to be a home run play, but it is a price distinction that plays itself out over and over and over, repeatable on every time frame. Yeah, you don't really have it here because you don't have the breach of liquidity. Okay, you have the distinction right here very clearly, right? You have this impulsive move up, Price comes up, runs above the highs, stops people out, slams back down. So you might not necessarily want to, I wouldn't necessarily trade when the price runs up above the highs, because at this point you don't know that this is going to happen, right? You don't know that that distinction is going to happen. Price could just keep trending, right? It's only after this reaction happens. So you see price run up above, stop people out, and then slam back down in the range. That's the point at which this becomes actionable, right? And then you can trade the retracement, looking for price to refill lower, right? So this is a good example of the fractal nature of price action. So you got this move here into a retracement within the context of what we were talking about before to ultimately fill a greater retracement into a 618, offer reaction there. Within this price swing, there are a number of tradable price distinctions. Anyway, I hope you guys like this video. Please make sure to like the video and subscribe to the channel, and I'll catch you guys in the next one.